Wall Street has long said or behaved as if there is a Fed put in the stock market. That is, the Fed would intervene to pop up the market if the stock market drops too much. So effectively, there's a floor on stock prices as if you have purchased a put option. And I have long thought that Australia has an RBA put in the housing market. Not that the Fed would like to put a floor on the stock market per se, or at least be known for it. But half of the population has saved directly or indirectly in the stock market, including many people's already underfunded retirement savings. Much more than half if you only count those who vote or make political donations. And the U.S. economy is so financialized and leveraged that a collapse in the equity market would do a lot of harm to the economy. So even if the Fed's dual mandates do not include financial stability, it has to act on it before it is too late. Otherwise, forget about price stability and full employment. Compared to the U.S., Australian households have more savings and wealth tied up in the housing markets. The housing market is also a more significant part of the economy. Think of the jobs and incomes of construction workers, real estate agents, and tradespeople who maintain investment properties. If the housing market crashes, the big banks holding a lot of mortgages would be in trouble as well. RBA has to pay closer attention to the housing markets than their counterparts in most other countries, maybe except China's PBOC. There's probably a Canberra put on the housing market, arguably more powerful as they not only have policy instruments such as fiscal and population policies. The new governor of the RBA reportedly has several millions of investment properties in Sydney, which is hardly surprising for her age and successful career. Now, I don't want to cynically suggest that just because she holds more investment properties than her predecessor, she is more eager to put in a floor to the housing market. Any half-decent economists who pay attention to Australia would know the differences in household balance sheets and sectoral structure between the U.S. and Australia, however. At the margin, I suspect that the RBA housing put would be slightly stronger. A governor with quite a bit of retirement savings tied up with the Australian housing market could probably sympathize with other property owners more if there is a housing slump. After all, there is empirical evidence that central bankers' personal experience affects their perspective when it comes to inflation, fighting despite the fully available historical data that are readily accessible. Similarly, the same alignment goes to legislators in the parliaments in Canberra and in state capitals, particularly noting a supermajority of voters are homeowners. Paradoxically, the Fed's intervention in the equity market or the RBA's intervention in the housing market may encourage more investment and risks in their respective domains. This is because they serve as free hedges. When the downside risks are limited, investors feel more comfortable investing in the market and taking on additional leverage. However, leveraging can amplify both gains and losses. Risky assets, such as stocks, carry a risk premium, which means they typically yield higher returns than safer assets like government bonds over the long term. Utilizing leverage may be advantageous for taking on more risk and earning a higher risk premium, but only if one manages the downside risk effectively. By curbing sharp price declines, central banks could inadvertently promote increased leverage and borrowing, which could eventually lead them to a more precarious position where they may need to intervene and bail out the market during significant negative shock. We witnessed what many refer to as a global margin call when the COVID-19 pandemic impacted the market.